Loss costs. Let's talk about loss costs, another part of the equation. Where are loss costs? Where are they headed? I think as an underwriter, we need to be very, very concerned about loss cost inflation at the moment. During the earlier part of the 2000s, we, in several different product areas, a very unique period of time for our business, saw actually loss cost deflation in a number of different products. Certainly not the norm. You take a look at the economic, political, social environment in this country right now. We've already seen the erosion of tort reform that happened during the Bush administration in the earlier part of the 2000s in various states. Caps on damages for Med-Mal, Georgia, Illinois being removed. So you're starting to see efforts to curb liability during the last 10 years or so being repealed. So a challenge for us as well there. On top of that, the uncertainty in which the health care bill, although obviously repealed yesterday by the House, obviously health care reform is on its way. Its impact really hard to know. But you add 30 million new customers to a current system that's going to tax the system, clearly create cost challenges and new areas of liability that we all need to be aware of. On top of that, new and emerging exposures, something we always need to be aware of. Diacetyl, butter flavoring, and microwave popcorn. Who knew that could kill you, right? Benzene, bisphenol A, whatever it is, the industrial toxicant of the day. We're really always kind of one scientific report away from having a new area of exposure that we all need to be aware of. So the likelihood of getting relief from the loss cost side of the equation, I think, also pretty remote. The regulatory environment, also a very, very challenging time for the industry. New regulation going to bring increased capital requirements in various parts of the world. On top of that, likely to bring new costs to our business. And while it's, I think, too early to understand what the Dodd-Frank bill would mean to us in the U.S. With a new federal insurance office for some companies facing new costs, new regulation. There are some elements of that legislation that we like in the surplus lines area. For instance, of our business, there's an opportunity for efficiencies and reduced costs that we can all enjoy some benefits in trading more efficiently with one another. Solvency II in Europe, very, very stringent requirements there. On the one hand, an area of cost for us as a business. On the other hand, a benefit. An area where I think it could become a model for regulation for our business around the world. And really, kind of almost the opposite viewpoint of regulation, which is more consumer-oriented here in the United States. It's more solvency-oriented in Europe, and again, I think an area where it could be the basis for global regulatory reform for us. That Solvency II could create some acquisition opportunities, some consolidation opportunities for companies in a position to take advantage of it. If you're diverse by product and geography throughout Europe, it creates some advantages for you. There are some specialty companies that I think will struggle with the cost of that, given how that reform and how that regulation works. So again, an area of cost, but also an area of opportunity for us. So again, the market is challenging, and I think will likely to continue to be challenging. The investment environment as well, I don't see relief coming from there. On top of that, we've got to be very, very mindful of growing and emerging exposures and loss costs in this economy, in this social environment, political environment in the United States as underwriters, and regulatory challenges as well. So really, no shortage of challenges, and I think the question is, how do you manage your way through that kind of environment? So how are companies doing it, and what is Chartis focused on to try to manage its way through these challenges? Well, some are returning capital to shareholders. Some are buying back stock for sure. Some companies acquiring market share in this state of the marketplace, which I think is something you all need to be mindful of when you see particularly aggressive companies at this segment of the market. Really, when you saw third quarter results, you saw a number of companies pretty highly criticized for growth in the U.S. marketplace, right? You saw other companies get upgraded for declining their U.S. business and growing in other parts of the world and geographies. So clearly a very, very challenging time. You've got to be very, very careful as you work your way through the market. At Chartis, we feel like we're well positioned, in spite of the challenges, to do relatively well in this segment of the marketplace. We do pay dividends to our owner, to our parent company, up to AIG, but we also have seen lots of different opportunities to deploy capital over the course of the last year. We see good opportunities for our business as we look at it on a global basis going forward as well. Clearly, it is difficult and challenging, and we've got to be focused on expense reduction and managing our business more efficiently. But as you all know, we spent a lot of time in the last couple of years playing defense in our business, given the challenges at AIG. However, we've not lost sight of how to play offense. We made a couple of acquisitions during the course of 2010. It's likely that we'll look at other opportunities in 2011. We bought a relatively small but a student health provider in our accident and health operation here in the United States during the course of last year. On top of that, we acquired a controlling interest in Fuji Fire and Marine. It was the fourth largest now makes us the fourth largest P&C company in Japan. It significantly increases our distribution platform and our foothold in that marketplace. So exciting opportunities for us there. And I mentioned we think there'll be some opportunities coming out of Europe. And there'll be some companies here in the U.S. as well that are going to struggle to differentiate themselves in this kind of market, and will find themselves in a position to need to sell their business. So on top of deploying capital kind of in that way, it's really about cycle management for us. So where do we see opportunities? I talked about the strength, or relative strength anyway, of the consumer segment. That exists for us here in the United States, so we're focused on growing the areas in which I mentioned. We operate in the consumer space. That's an opportunity for us globally as well. I mentioned that 20% of our business in the United States is consumer-oriented. A third of our business globally, something else that may surprise you, but a third of our business around the world is consumer-oriented. In fact, half of our business outside of the United States is consumer-driven. So a big opportunity for us to grow in that sector. Generally speaking, kind of the farther you get from New York, the more different our business becomes. Our business in Europe is a lot like our business here in the United States, but when you get to Asia, the business is far more consumer-oriented. It really flips over the other way. So big opportunities for us to grow and deploy capital to the consumer space. In addition to that, our specialty markets are areas of opportunity for us. Again, on a relative basis, producing decent returns, acceptable returns at this segment of the market, so we continue to be focused on that. Multinational business, right? We have a very unique franchise, really an unmatched franchise in terms of its footprint. The infrastructure that we have around the world, the larger customer, the multinational customer, values that footprint, that infrastructure more and more every single day. Really, when you look at our business during 2008, 2009, the business that got hit hardest by the AIG-related reputational risk was our D&O business in the United States. Well, we sell a passport service to our customers in that space, where we can offer a service to issue locally admitted policies to our customers in foreign countries all around the world. We had roughly 250 accounts, not policies, but customers that availed themselves to our passport capacity, our capabilities in that space during 2009 and 2010. We lost one of those accounts over that 2-year period. So it speaks volumes about the strength of our infrastructure around the world. So we're focused on expanding that competitive strength that we have there and making it easier to deliver that to all of you and to our customers. So again, an area of investment for us. On top of that, the international business generally. I mentioned that the European market faces a lot of challenges, just like we do. The business there is a lot like our business here, but we're market leaders in a lot of emerging economies around the world. In fact, we've formed an emerging markets practice, where we try to leverage really our competitive strengths in all of those new markets around the world. So again, a challenging time, a challenging market for all of us, but areas of opportunity too. We feel like we're positioned well, given the diversity of our product, given the diversity of the geography that we operate in, and the competitive strengths of our franchise. I mentioned the infrastructure we have around the world, the people we have. For the first time really in my career, our claims handling and our policy administration are competitive strengths of ours, and so we're proud of that as well. So again, a challenging time, but areas of opportunity around the world as well. So again, I thank you for your time. Those are my thoughts, and I'm happy to take some questions.
You didn't give us a definitive time frame when it's going to turn from a soft market to a hard market. An educated year, guess, quarter?
That's right, I did. I've heard a lot of CEOs be very, very wrong on that over the course of the last couple of years. You know, the supply-demand imbalance is pretty significant at the moment, and that's why it's hard for me to see any kind of meaningful change. You know, you have to see it really, I think, an extraordinary event to tip the scales in a different direction. So again, I think you know, I think that it's likely that the market will remain fairly competitive throughout 2011. Beyond that, it's hard to know. You know, when you look at the business 30 years ago, in 1980, the rating agencies and regulators required us to hold, you know, a certain amount of capital to support our business. The interest rate environment, obviously very, very different 30 years ago. 100 combined ratio in 1980. Average kind of mix of business, relative average mix of business, 16–17% return on equity. In today's environment, with the interest rates where they are, with rating agencies and regulators requiring us to hold more capital to support our business, that same 100 combined, again with an average, relatively average mix of business, you're going to get low single-digit ROE. And that's where the pressure point, I think, is going to come in the near term. I actually think, and I may not, I may be out on my own on this, but I actually think the market's actually acting a little bit more responsibly from a pricing point of view than I've seen in other soft cycles. It's not to say we don't all see stupid things from time to time. We all make mistakes from time to time. Those are certainly, there are plenty of examples of that happening out there. But relatively speaking, I do think the market's probably acting a bit more rationally than it has historically. But clearly investors are breathing heavy on the U.S. P&C market. Again, when analysts are downgrading you for growth in the U.S. business, that speaks volumes about what the institutional investor thinks about the performance of the business in the near term. So, question?
Yeah. Can you please comment on both the Federal Insurance Department and the combination of the real estate and banking and insurance here in New York?
Don't give them an idea to throw real estate into.
Throw real estate into. I saw Superintendent Wren at a RIMS event, I think a week ago or so. And you know, it sounds to me like New York is absolutely headed in that direction if that's going to happen. You know, in terms of the Federal Insurance Office, as I mentioned in my comments, I think it's too early to know what that's going to entail. But you know, with new regulation, are going to come new costs, new requirements. Certainly for the large multi-line, multi-state carriers. I did also mention though that there are some good things in there, right? Surplus lines reform being, you know, probably the most notable example. But there's I think it's way too early to really know what the ultimate costs and hopefully benefits will be from that legislation. Tony, you have something?
Yeah, John, my comment had more to do with the follow-up on New York State. I mean, the concept, and you mentioned it, outside of New York in business is a lot different than it is here. But the issue of having banking regulators being the driving, which is what's happening in other states.
That's right.
Banking regulators seem to be the driving force of those departments, and they don't really understand often the financial workings of our business. So I'm just curious about how the New York situation.
Haven't done that.
What things we should be thinking about, what things we might need to be doing as an industry, to let Albany know what we think.
We have to speak with, not that we'll necessarily all agree, right? But we have to speak loudly. I mean, the PIA has got obviously a large voice, and my advice is to make sure that voice is is heard. I do think I'm encouraged by some of the things I'm hearing out of Albany. This issue obviously may be a bit different and can likely will create some challenges. We've got to make sure people that understand our business are the folks that are regulating us. And look, I think while the state regulation arguably in the U.S. isn't the most efficient way to go about regulating our industry, I think the state regulators also stood out in a very positive way throughout the credit crisis. The performance of the industry relative to to other financial services, I think they have a lot to be proud of. Other questions? Leslie, anonymously looking over the crowd.
Hi. Are we done with questions? Any other questions for John?
Well, it's good to see all of you, and thank you again for your support.